Hey, my friends, welcome. We are live and we are on the February 2023 San Diego County market update. As usual, I'm going to just deliver the facts, what you really will very rarely, if ever, see in the news. We'll take the statistics that are always twisted and we'll just go, I'll decipher exactly what it means to the marketplace right now, where we see interest rates going, all of it, and with a zero agenda policy, right? Just what we're going to just go after, what it is, and not try to twist it into it's so good for buyers, so good for sellers, none of that nonsense, just the information that's so hard to get. So before we even continue, welcome. And it would be great if you please would just let me know in the chat that you can see me, you can hear me. If you would just chat in there, just to make sure that the audio and everything, the video is coming through correctly. And so if you could do that, that would be great. In the meantime, I'll just remind you that if you're watching this later on in YouTube and you have any questions whatsoever, whether you're making a move in 9 days, 9 months, 9 years, we receive questions, texts, phone calls, emails from people like you every single day. We absolutely love it. Thank you, Mary. Thank you, Kimberly. We see that you're seeing it. Awesome. And so go ahead and shoot that through. And thank you very much, Frank. Okay, awesome. So it looks like everything's working perfectly good. Steve, thank you. Raymond, thank you. Let's get going. And per usual, my commitment to you is to get all of it out in as close to 20 minutes as possible, as we do every single month. So let's kick off. Okay, that all is looking right. And I'm going to just check one more thing, make sure my camera is where I need it. And we are off and running. Okay. So here we go. Really quickly, if you don't know me, I run Beer Home Team at eXp Realty, sold over $2.5 billion worth of real estate in the last 17 years here locally, landed us on top 50 Wall Street Journal, I think 5,000 4 times, blah, 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 blah. Point being is, yes, I've seen it. I've been through different markets, been through different recessions, expert guest on a lot of the local news channels. So let's move on from that. Though it would be great to just, I always give you a quick update on the personal side of life, because I'm not just the guy on the billboards. I just was in Ecuador climbing some big volcanoes out there. That one was a 17,000 foot volcano that we summited there. It's called Iliniza Sur. Just came back from Tahoe with my family. And so there's my little girl, my 2 little boys, my wife and I there on the train tracks, and our other family member I don't think I've ever introduced you to. That's our little pup there, Gracie. So I want to start off with this right here. American Banker had a headline, and the headline was, "Is it time to quit mortgage in real estate?" The reason that they created the headline is it makes sense. There's literally over 60% less volume in the mortgage business. Okay, this was from a mortgage publication. 60% less volume, less income running through that industry. And so they're saying, hey, is it time to jump out of the industry? Well, let's take a look at what's going on. And then I'm going to circle right back to this. I think you'll like what I'm going to show you. So first off, just a quick total market overview of what's happening in San Diego County. This is, remember, a comparison of what we're seeing this in the previous month, right? So this is the February update, giving you January numbers and comparing that to the previous January. Comparing new listings, down 31%, which sounds extremely negative, but I do want you to look at this little blip here on the bar chart. And we had a tick up, so a little bit more hitting the market. This one's exciting, the next one, pending sales, down 25.3%. So the reason we're here is, and I'll remind you, by the way, I answer every single question myself. So if you have a question, send it through in the chat. You can also email me. I'll give you an email at the end, but you can send it in the chat here as well. But the reason we get together for these market updates, 25.3%. So that's factual. Okay, that's how much less pending sales we have this past January versus a January ago. Having said that, look at the bar chart. It's the first time in 5 months that we actually have a jump in pending home sales, and a pretty good jump at that. So that's the kind of information that, remember, the news and all the talking heads and the pundits, all of them, they are paid to make you click, to make you pay attention, to make you panic, to make you worry, and to build fear. So that is really critical. Okay, we're seeing a reversal there. We're seeing more activity. So that's really, really positive. Having said that, Closed sales, if you look at the bar chart, we have not seen that yet. The reason why is closed sales depend on what was pended a month or 2 months ago. So that's still trending in the opposite direction where we want. But based on what we see on pending sales, we could very accurately guess that we're going to see closed sales improve, if not in the next reading, certainly in the following one, okay, once all these current pending sales are closing. So that's something to look forward to. Median sales price, $767,000, so down 1.2% from a year ago. Not dramatic movement. We'll talk about how much movement has there really been in pricing. We'll look at delinquencies. I'm going to take you through a lot of good information today that you can use to not just like be reading the headlines. Average sales price up actually 0.9%. Okay. So, you know, at these price points, however, $1,012,000 a year ago, $1,021,000 now, I'm going to tell you, lean more toward the median number. The average can be skewed by a lot of high-end sales. We're still seeing more sales on the extreme high-end than we used to see. So that trend has continued. That's why you have the discrepancy there between median and average. I'm going to take your attention down here to days on market. Days on market up 90%, okay, from 22 to 42. So it's a huge jump up from 22 to 42. And when we look at the bar chart, it has only gone up. Now, are we going to see that reverse? I think you're going to see that, if not slow down, then finally reverse a little bit based on the pending sale number. But again, those pending sales, they don't become closed data until 30, 45, 60 days later. So that's, hopefully there's relief in that climbing days on market, which is just really downward pressure on sellers that have to make changes with what they want on their pricing. Good news for you if you're a buyer, bad news for you if you're a seller. Though again, I do see that starting to flatten out or reverse based on that pending sale number. Just to round this out, month supply, we're at 1.1 month supply. A year ago in January, we're at 0.6. So that is the kind of story that the news will absolutely grab onto, right? You'll see that headline, 83%, right? Supply up 83. Well, yeah, it's up 83%, but it's dramatically low still at 1.1 months. So it's important that we actually look at that. Again, as a reminder, if you haven't been with us before, it's not till you get to about 4 months or so of inventory that you have that kind of just even balanced market, all the way from 4 to about 6 months. When you're north of 6 months, that's your buyer's market. So we're a long ways away from that. All right. And again, anything that you type into the chat, send my way, I will answer for you. Let's grab a look really quickly at mortgage rates and inflation. So mortgage rates, and actually I want to take a look really quickly first at mortgage rates and affordability, then we're going to go to inflation. 30-year fixed mortgage payment. This is that stat we've been consistently giving you month over month so we could track its movement. Well, on an $875,000 house with 20% down, that's a $700,000 loan. Today, that rate is right at about 6.5%, which would be a payment of $4,550 with 89 cents. That same payment when we saw those really low 3% rates would have been $2,951. Difference between the two being $1,599. Let's just call it $1,600 more for the same mortgage. And so that's really significant. Okay, for a lot of people, that means you just simply do not any longer qualify. And that is a big deal as we see these 6.5% rates, because rates, you'll remember, had topped out right at around 7%. They'd actually dropped into the low 5s, and now they're back to 6.5%. And that's going to be told by the inflation story. I'm going to take you there in just a moment. I do want to remind you of something we covered last month, which was that some of that affordability that is devastated there by that $1,600 additional payment for the same mortgage is to some degree mitigated by the fact that salaries are up about 7.6% over a year ago. Okay, so that means that on a $100,000 household now earning $7,600 more, that gives them $633, right, to chip away at that $1,600. So essentially, the mortgage payment difference is really, from an affordability standpoint, about $1,000 versus the $1,600 that it would appear to be. I hope that makes sense. I have a lot to share with you today. So whether you're watching this later on a replay, if you're on YouTube, you can hit the rewind button. Of course, you can toss any question my way. I'll take it deeper there if I've at all confused you. So let's take a look now at inflation. Okay, CPI, Consumer Price Index. Let's go down memory lane here really quickly. In November of 2022, CPI was at 7.1%. December was predicted to be at 6.6%, came in at 6.5%. And you'll remember what happened. We went from having 7% rates to dropping all the way into the high fives. And so part of that because we went from 7.1 to 6.5, but part of that because the market was predicting 6.6, and when it came in at 6.5, the market dramatically celebrates, and on the negative side, which we'll see here in a moment on the January reading, overreacts whenever it's wrong. Okay, so the January reading, which just came out, right, in February, we get the January numbers. It was predicted to be at 6.3%, came in at 6.4%. And so we've seen rates really jumping on the back of that. Here's what that looks like. I want you to take a really close look here at this. So you'll see this is month over month, the CPI reading for that particular month, taking us all the way back to where are we? June of 2021. You'll take a look at the circled 3, okay, that I have there. The circled 3 months, October, November, and December of 2021, 0.7% inflation in October, 0.6% in November, 0.7% in December. Now, the CPI right here on your screen is far more than 12 months, but the overall CPI that I was showing you over on this slide, okay, these numbers, those are 12 months lumped together. So when October, let's go forward now to October of 2022, when that came in at 0.3, it knocked out a 0.7, you get improvement. November, when you knocked out a 0.6 from 2021 with a 0.3 from 2022, you get CPI, you get what we call inflation improves. December 0.7, you get a 0.4, it all improves. Now, here's what's interesting. January of 2022, you see 0.6 was the prediction. We got 0.4. Why did the markets react negatively? Well, two things went on. One is the jobs report. The jobs report came in reporting that, hey, we've actually gained 500,000 more jobs than we expected. And so therefore, we're expecting that, the market's too hot. We're going to see too much inflation. So the really sick thing about all this is that with the strong jobs report, you actually get negative, or you get adverse reactions. You get the reaction we do not want. The market reacts poorly with a positive job report. That's kind of twisted, but that's just the way it works because it signals that, hey, there's still a lot of demand. That's why there are so many new jobs. All the demand is driving new jobs. And if there's so much demand, there's going to be upward pricing pressure. And so remember, mortgage rates follow inflation. And that's why we're talking so closely about inflation every single month that we get together here. So what happened is they were predicting, just like I told you about back here, right? They were predicting that this 0.4, you'll see December 2022, or excuse me, January 2023, the last number on this chart. They were predicting that would be a 0.3, excuse me. They were predicting that would be a 0.3, came in at 0.4. So either way was better than the 0.6 from a year ago. Either way, the overall CPI number, Consumer Price Index or inflation number, decreased, but not as much as Wall Street had thought it would. And so you get this really adverse reaction in the bond market and adverse reaction in the mortgage market. So what does that mean now looking forward? Okay, let's take a look at when we get the next reading in March, which will give us from the February numbers, we're going to be knocking a 0.5 out. So you'll see October 0.3, November 0.3, December 0.4, January 0.4. We will hopefully see a number that's better than 0.5. So next month, we should have a pretty good reading, nothing huge, nothing probably too crazy expected in either direction. Get ready that the following reading in April, giving us the March numbers. In March, we had this blip down a year ago in inflation. So we're going to be replacing a 0.3, probably with a 0.3 or maybe even with a 0.4. If that happens, which it likely will, you're going to see all of everybody on TV, all the pundits talking about how inflation is out of control, blah, 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 blah. Here's what they're not looking at. The chart in front of you is something completely off their radar. Look at now the following month when we get those April numbers, okay, which will come out on May 10th. May 10th, which is a date you want to be aware of and, you know, put it in the calendar. On May 10th, we get the April reading. Well, we're going to knock a 0.5 out, hopefully with a lower number if this trend continues. May 0.6, June 0.6. So you see you're going to go on a 3-month run of having really high CPI numbers from a year ago replaced by lower numbers, and we should see a positive report in inflation. We should see the right trend in mortgage rates. And so in July, we'll see another one of these low blips, 0.3. So we're going to have to survive July, but then take a look at August and September. So you can see how when you go April, May, June, and then you have that July, but August, September, you have a 6-month run there where at least 5 of those 6 months, we should be able to have positive result in having lower inflation reported, which will drive rates down. And for those reasons, I believe that we will start to see rates push back into those 5s and even pretty darn close to the lower 5s as opposed to the higher 5s as we did just a short time ago when we saw that rate relief. Now, what will the Fed do next? Let's go ahead and discuss that. And I see the questions coming through here, so I'll make sure that I answer that. And Fabian, thanks for the question. How did the gap between the 30-year mortgage and 10-year Treasury yield evolve recently? Interesting you ask, because we're going to talk about that in just a moment, Fabian. So I want to show you first, though, what's being predicted, okay, for when we talk about the Fed raising rates. Remember, they're not raising mortgage rates. What they're raising is the federal funds rate, the rate at which banks essentially borrow from the Federal Reserve and then, you know, pass it on to us. So right now, the current target rate is 450 to 475 basis points. It's or 4.5% to 4.75%. We just call it basis points, 450 to 475. When the Fed meets next, March 22nd, it is predicted, Wall Street is currently betting 73% chance that there's a 1/4 point hike. They do, however, now see, based on the recent not as advantageous report, that, you know what, if there's a 27% chance the Fed could decide, we need to be a little bit more aggressive and go a 1/2 point. Okay, so this is the current prediction for the March meeting. Now, odds are we go to 475 to 500. The following month, odds are we go to 500 to 525. Though again, the Fed, or the marketplace, I should say, is predicting a reasonable chance that there's an additional 1/2 point hike at that time. So that's just something to watch. Now, what's going to move this? Remember, if we get what we expect, everyone's happy, the markets react well, rates will drop. What will move this is if we keep seeing really strong employment numbers, which, going back to those employment numbers, by the way, when it was reported 500,000 higher, reality is there was a loss in actual jobs, but there's seasonality factored in the January reading that will not be there moving forward. So you'll very likely start to see loss of, you'll very likely start to see a loss in terms of jobs when the future jobs reports come out. Okay, let me take you finally out here to what we're going to call the terminal rate. They think that it will top out at 525 to 550, and then that in June at that meeting we will not see an increase in what the Federal Reserve sets rates at. So that's the current prediction as far as what the rate of the Fed is doing. Fabian, you asked about, I'll read your question now. How did the gap between 30-year mortgage and 10-year Treasury yields evolve recently, past few months, especially considering the recent economic developments like CPI, high consumer spending, and low unemployment? Awesome. Great question. So check this out. The relationship between 30-year mortgage rates and the 10-year Treasury, that spread has traditionally been about 175 to 200 basis points. I showed you this a month ago. And right now, you'll see, because rates are up, and the 10-year is, so when we're tracking that gap, right, the 10-year right now is right at about 3.89 is what it's at. 3.89% is the yield on the 10-year Treasury. Rates are right at about 6.5. So when you look at that gap, it is a wider gap, right, than the normal spread. You'll see over the course of history that spread has pretty consistently been at 175 to 200 basis points. The spread eventually reached 300 basis points. And right now, 6.5 to 3.8, it's not quite at 300 basis points. It has lessened some, but it's still well north of the 200 basis points gap. What does that all mean? It means that when things normalize, as you see the 10-year Treasury note start to come back closer to 3.5% and eventually 3%, you should be seeing that those mortgage rates going to 5.5 and then 5. And there's other factors, of course, involved. I can't cover every single one of them on this one. A month ago, if you go and grab that one, and if you need it, just let me know. I'll send it to you. We covered that in really a ton of detail. But there's a lot involved with that, and especially as it has to do with the way shelter is affecting in the inflation numbers, and also how recession is affecting the coming recession, I should say, is affecting what mortgage rates will do. And we'll talk about that in a moment. We'll talk about how it is that mortgage rates, or that the real estate market traditionally does so well during recessions. We talk about that a lot, but I'm going to paint a picture as to why that is for you. Okay. Now, I do want to say this really quickly. Home price moderation is hardly a crash. Okay. So if you look, we're really down. You know, this is a national look, down about 2.5%. We just took a look that our January's down 1 point, whatever it was from a year ago. It's that blip. And let's go deeper here. Delinquent mortgages, which would drive a lot of that downward pressure. Okay. This is not the 08-09 crash. It's just not. Look at this. 30-day lates are at 3%. Okay, so 3% of mortgages, 30-day late. Seriously delinquent, 90-day plus, only 1.2% of mortgages. And in foreclosure, multi-decade lows, 0.3%, 0.3%. That's it. That's literally a multi-decade low. So you do not have any kind of environment anywhere near what you had in 08-09. This is more categorized as kind of from a real estate market perspective. We could categorize this much more as like a low, just there's low transaction count. There's not a lot on the market. There's not a lot being absorbed. We did see those pending numbers rise, like I showed you. But let's come back here and take a look at the coming recession. The reason we want to focus on this just for a quick moment is when you look at the fact that recessions have traditionally always actually given us a fairly strong housing market for a couple of reasons. And one of those being that people have a flight to safety, flight to something tangible, hard assets, gold being one of them, of course, but real estate being one of them, things people can get their hands on. So I want to just take you back through this if you missed it a month ago, but this is still very much just the way it goes right here. Top one is showing us credit card and other revolving debt. So we as a society, we're building all kinds of debt. Okay, and this takes us from 2018 all the way to that white bar, up that vertical white bar. That's the pandemic, okay, and the Great Recession. Or excuse me, not the Great Recession. That's the 2020 pandemic recession. So what happens is all of a sudden you have all kinds of stimulus money that comes in. If you look down at the bottom here, you'll see savings rate was just pretty steady. All of a sudden, you get all this stimulus money. And what happens is you see the debt just plummet. Personal revolving credit card debt just plummets. Why? Well, everyone takes their stimulus checks, and sure, they might have bought a few things, but they end up paying off a lot of the debt. And then they have a whole bunch of leftover money, which is interesting because now what happens is they actually start spending that. That's why you see that savings rate starts dropping after they get the big spike in savings, but that was just stimulus money. Then they pay off the debt. You see on the top chart, boom, debt's down. And then they start financing with that stimulus money, new lifestyle. Then they get that second stimulus money. That's that second blip you see. And then that third kind of higher blip you see on the bottom chart. All the while, what's happening is they've created now, they being Americans, right? All of us created lifestyles based on fake money. So to continue that lifestyle, you see now savings rates plummeting, debt going to its highest record numbers. That is something to watch. Recession is coming. You cannot have a record number of debt and low savings, and expect to have a healthy economy, a healthy society that will sustain it. So that's coming right there. Actually, before I take you to the housing forecast, I want to illustrate this really quickly. Also, if we go up, okay, 1% in unemployment, I'm just looking at some notes here that I wrote for you. If we go up 1% in unemployment rate, we lose about 1.5 million that probably will not be looking for homes. I mentioned that because I'm talking about recession. With recessions is always job loss. So that is going to be devastating for about, every 1% in unemployment, which is what the markets, interestingly enough, want to see before the Federal Reserve stops raising rates so that finally we will get relief. Well, but that means that a lot of people get affected, okay? About 1.5 million people get knocked out of the housing market. Having said that, with recessions historically have come lower rates because of what we just said. The Federal Reserve says, hey, our policies have kicked in. We do not any longer have to keep raising rates. Maybe we'll even drop them. Mortgage rates and bonds follow. And what happens is for every 1% in mortgage rate drop, you get 5 million new borrowers that qualify. So 1% unemployment, yes, that will give us 1.5 million people who will not qualify, but every 1% in mortgage rate drop gives us 5 million people who qualify. And now you start to see a little bit of the picture, just giving some color to why it is that over the course of, say, the last 30, 40 years of history, aside from the Great Recession, where the Great Recession was caused by real estate. So if you ignore the Great Recession, where it was the cause of the recession, in every other recession that we can talk about, going back to about 1980, real estate's done better than other asset classes. And that's just the illustration of why it's that relationship between how many people we lose as potential borrowers when there's unemployment versus how many people we gain when those rates drop and the recession itself influences the rate drop. So just kind of an interesting intertwined concept there. So housing market forecast, let's hit this now. Low single digit appreciation for most of the US, okay? Increased activity. That's the forecast. Remember, once we start seeing those April numbers hit on May 10th, and those 3 consecutive readings, we should see dropping CPI numbers, which should give us lower rates, which should give us a better housing market. We'll see that blip down in July where it won't be so great, but then we'll have another run of 3 additional positive readings if things pan out the way that we've saying they will, but so far they have panned out the way that we've been saying they will. So we see lower inflation, recession-like slowdown which actually pushes rates down further. Incomes increasing to help affordability. Very tight inventory. Rents are still expensive and rising. And rates move near 5% by the end of July. And again, that's because of those CPI number readings that we were talking about. I want to take you through one more concept, which is just interesting here. I'm looking at my notes. So when we got this January reading just a few days ago, right? And I said January reading a few days ago here on it was February 14th, I believe, when we got the reading on Valentine's Day. And those were the January numbers. So what caused those numbers to be a little bit worse than expected? Well, here's something really interesting just to close out today. There's something called the cost of living adjustment. Okay, the cost of living adjustment, it happens every single year. And what's interesting is Social Security, it's a Social Security adjustment for inflation. Okay, so that's what that is. So it's not just a one-time adjustment. It's not like they give everyone on Social Security, hey, here's a little extra money this month. It's a sustained adjustment. It's permanent, right? It's an ongoing month-over-month adjustment. So what happened, it took effect in January. 70 million people got 100 and now are getting $140 extra a month. 70 million times 140 per month. So did some of that maybe go and pay off a little debt? Take care of some bills? Sure, but did some of that make its way into the retail market? Of course. And so we saw the retail readings and it could explain why they were a little bit higher than what was expected. So just all of it's all really fascinating. By the way, I appreciate your time you spend with me here. I spend hours upon hours every single month studying the markets for you, and I try to distill it down here within about, what are we at right now? We're actually at the 30-minute mark. So I try to distill it down. I always say within 20 minutes, definitely within 30. So I'll close out right here. If you have any questions whatsoever, you let me know, but I'm going to bring you back before we close this graphic. Remember this is important. Just check this out. I opened with this. I showed you this headline published on American Banker, how it might be time to quit real estate and mortgage. And it's all, the article will go into how just mortgage activity is devastated, down 60% plus, et cetera. Well, guess what? What I didn't tell you is this was actually published in 2014. And Barry Habib turned me on to this because he pulled this little same trick I'm pulling on you. He pulled on me, showed me the article, and then finally revealed the fact that it was actually a 2014 article. So what's happened since 2014? Has real estate done better or done pretty okay? Are prices higher than they were in 2014? Have people made money in the mortgage markets, in the real estate markets? Has wealth been created in real estate for those that ignored these headlines? Of course. So make sure you understand the numbers. My goal will always be to just deliver straight facts to you every time we get together here. Shoot any question you have to dan@beerhometeam.com. Okay, dan@beerhometeam.com. I answer everything personally. And if you're watching us on YouTube, please make sure that you hit the subscribe button, tap that bell for notifications. Every single day we receive text messages, phone calls, emails. We set up Zoom calls with people just like you looking to make the move. And I appreciate you guys. Let me know where I can clarify anything. And this has been a great day. Take care. We'll see you on the next one.